This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
I really encourage you to get involved with Jason and his team. The whole group over there is just fantastic. I started working with them probably 10 years ago. I think the world of this group. They've helped me a lot, and I think that you'll really enjoy the process.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1756. I want to take you back in time before we start today's show, and let's just go back in time to October of 2020. You know what I'm always saying, right? If you don't have a sense of history, how can you understand the present, right? How can we understand the present if we don't have that context, that historical backdrop? That is why I love history, why I'm a student of history. And this isn't very historical, but we'll just go back a little while. It's not like I'm giving the advice, watch old movies, old TV shows, read old books, and listen to old music. This is just back to October of 2020. And I'm looking at a chart here that says the share of new homes purchased before they are built is at the highest since 2005. Share of new homes sold that had not yet started construction. So these aren't even under construction when they're being purchased. It's just pick out your lot, tell us which house you want on it, and we're going to build it when we get around to it. When we have the crew, which is in short supply, that labor. When we have the raw materials, also in short supply. We've all heard and talked ad nauseum about the supply shock problems. So that is the question. Okay, so as of October of 2020, 39% of all new homes were purchased before they even started construction, and that's the highest since 2005. And going back further in time, it was fairly high in 2001, but very, very high now. Very low, as you can imagine, in 2009, Great Recession era. But what's interesting about this, well, maybe it's not that interesting, but April of 2020, just compare it to that. What a difference 6 months can make. Now, of course, that was during the lockdown era, so unless you're in Melbourne, Australia, and you had almost a year of lockdowns, right? So absolutely ridiculous. But only 20%, half the number, being sold or purchased before construction begins. Very interesting. I would love to see the update to this chart, but I don't have it. So that's a little history. It's interesting. I'm sure that rate is much higher now. So, real estate bubbles. Everybody's talking about bubbles. What happens when you look around the world? We are living in an entire world of cheap money flooding the planet. Negative interest rates. Cheap money that is lower than the cost of real inflation for sure. But now, maybe for the first time ever, as I talked about if you saw the live stream today, well, yesterday I should say, because you're going to hear this tomorrow. Anyway, on yesterday's live stream, I was talking about how negative interest rates, maybe for the first time in history, are now based on not the real rate of inflation, but based on the official rate of inflation. That might be a first. I'm not sure. I would venture to guess that it could well be a first, where they tell you the official inflation rate is, let's say, for example, 4%, and then they say, but you can borrow money on a 30-year mortgage, which is backed by the government through its government-sponsored entities, Fannie Mae, Freddie Mac, etc., FHA, VA, USDA. There's more than just the two we talk about most of the time, all right? So, and you can borrow that money at maybe 2.75% if you're owner-occupied, and if you're investor, maybe 3.25%. Lower than the official stated rate of inflation. That is unbelievable. It's incredible. So what is that doing? Well, it's causing all this bubble concern. And some of it is valid, especially in the cyclical markets. In the linear markets, I don't think so. So when we take this tour around the world, before we get to today's guest, by the way, today's guest is John Hyre, and he'll be with us again on Wednesday talking about, well, all these changes that are coming maybe to retirement plans. This is a big deal, obviously. Now, thankfully, we have not gone heavy in preaching that people should get these plans, use these plans. We've talked about it a bit, but it hasn't been a big thing for us because I've never been totally sold. Never been totally sold on it. In fact, my own plan, there are several years where I haven't even bothered to fund it. I certainly could fund it, but I kind of like having the money out of the plan where I can do what I want. But if it's not available that way, a self-directed plan is the next best thing. But as you'll hear, those are now under attack. Will that be the case? Will the government succeed in this? We don't know. But eventually, they probably will. They may not this time around, but eventually they will. Because the government doesn't like when you are in control of your investments. And they can't go and commandeer those assets like they can all of the non-self-directed plans that are just in brokerage accounts with big brokerage companies. Stroke of a pen, change the law. They now own those plans. For our own protection, of course. Yes, for our own protection. All right. So John Hyre will talk about that when we get to our guest portion here in a few minutes. But let's take a look around the world. Now, this is a chart from Visual Capitalist, which is an interesting website. They've got all sorts of graphical interpretations of things. Check it out. It's a pretty neat website. I've looked at it for many years. And they rank markets around the world in terms of their bubble risk. And they say that if it is above a 1.5 rating, it's got a bubble risk. If it's 0.5 to 1.5, it's overvalued. And under that, it's fairly valued. Okay, well, let's take a little tour. Now, you've heard me talk when I talk about linear, cyclical, and hybrid markets. You've heard me talk about many of these markets that are in bubble territory. So it's interesting that the interpretation is pretty much the same. And I don't know that I totally agree with all of these. I would place a lot more of them in bubble territory than they do. But hey, it's their ranking, so let's just go with their index. Number one, most overvalued bubble market in the world, according to Visual Capitalist, Frankfurt, Germany. Number two, Toronto. Then, and I won't say the numbers each time, but 3, Hong Kong, Munich, Zurich, Vancouver, Stockholm, Paris, Amsterdam, Tokyo, Sydney, Miami, not too far from me, Los Angeles, where I grew up. Now we're going international again. Geneva, London, Moscow, Tel Aviv, San Francisco, back here in the States, Boston, New York, here in the States. I've mentioned all of these as bubble markets many, many times, so I'm not surprised by any of this. And in the fairly valued, there's just a few fairly valued markets, according to them. Singapore is right on the borderline of fairly valued. Madrid, Milan, and Warsaw, Poland, of course. And undervalued, according to them, but I don't know that I'd agree with this, Dubai. Of the 25, it's the only market they say is undervalued. But they didn't even mention all of the linear markets or any of the hybrid markets in the US. So they didn't get that far down the list because they only ranked 25 of them. So that's interesting. I would push way more into bubble territory than they did. I guess I'm more pessimistic about the housing market than they are. But hey, we will see what happens with how bubblicious the world is. And look, these markets, because they have overappreciated, they will come down the most. Just remember, whenever you've ridden a roller coaster, you know that first time you leave the entry point where you get on the roller coaster and maybe your heart is beating and your blood pressure's up, and they kind of tease you with what's going to come. And one of the ways they tease you is they take you up this big hill, and it goes clank, 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 as the roller coaster is being pulled up the hill on a chain. And you know, you're thinking as you get up there and you look around at the environment, wow, we're awfully high up. This fall is going to be a doozy. Can I get off now? Where's the chicken exit? And you know that hill's going to be large, and it's going to be a big, big, very fast, very scary ride down the hill because you went up so high. And so that's the breadth of these cycles. And the linear markets have very little breadth. They're like riding the kiddie roller coaster. So you go up just a little bit, it's no big deal. You go down a little bit during the recession points, and then you go up a little bit again and down a little bit. It's very linear, it's smooth, it's even, it's not extreme, it's not exciting, it's not in the news because there's nothing to report. It's not newsworthy. It's no big deal. But in those cyclical markets, the higher they go, the faster and harder they fall, as the saying goes, right? So much more pronounced. I mean, the roller coaster is really a perfect metaphor for that. So hope it makes sense to you. All right. We have, oh, by the way, did you enjoy Flashback Friday, where we had Adam Taggart, who works with Chris Martenson, and Chris Martenson will be speaking in person at the Collective Mastermind meeting, which is less than 2 weeks away in beautiful Scottsdale, Arizona. I'm headed out there this week, and we've got Chris Martenson, we've got Robert Kiyosaki, Mark Victor Hansen, the co-author of the Chicken Soup for the Soul series, which has sold 500 million books. Absolutely incredible. We're kicking it off with Mark Victor Hansen, actually. Of course, Ken McElroy, George Gammon, myself, because, hey, it's our group. And we've got Carrie Lake, candidate for governor of Arizona. And gosh, I know I'm missing some, but we've just got such a great lineup. Wonderful speakers. And we're going to go race car driving. And we're going to have an awesome fashion show on Saturday evening. So it's going to be a great time. If you're interested in a high-level mastermind group, I'd urge you to check out The Collective. Go to thecollectivemastermind.com, thecollectivemastermind.com, and check that out. You can apply there, and we'll get back to you and schedule a private Zoom meeting with one or all of the three of us and see if it's a fit for you and see if you can increase your portfolio and your income and your wealth by joining the collective. If it makes sense, then hey, join us. Okay, without further ado, let's get to John Hyre and let's talk about these retirement accounts and how things, well, what was it, Bob Dylan who said, times they are a-changin', right? Here we go. It is my pleasure to welcome John Hyre to the show. He is a tax attorney. He lives in Puerto Rico, so he's taken advantage of that awesome Puerto Rico tax break. And he really knows his stuff when it comes to self-directed IRAs and solo 401ks and so forth. And we're going to talk about that today, as well as some other things and this new legislation that we should all be very concerned about. John, welcome. How are you?
Very good. Glad to be here. No matter what happens, the tax lawyers always win. So,
well, all the lawyers always win no matter what happens, right? Not just the tax attorneys.
and it's a coincidence that we dominate the legislature. So it's a pure coincidence.
Just a total coincidence, I'm sure. So, John, tell us about your practice first, if you would, and your areas of expertise.
The practice itself is focused mostly high net worth individuals, real estate investors, self-directed IRAs, 401ks, et cetera. And oftentimes, of course, those categories all intersect. I now only do planning work. I used to do returns. And when I do the planning work, it's really more as the quarterback. I review people's structure top to bottom. I go through their books. I go through their entity structure. I go through their taxes. I see what they're deducting, what they're not. We come up with a plan. And for the most part, I'm not the one implementing. Now, I'll review. For example, we may hire lawyers to set up entities, and I have people I refer them to, but I still want them using my templates, and I want to be able to review what they've done. Been doing it now for about 27 years, been on my own for just over 20 of those years. So mostly the planning. I still fight the IRS periodically just for fun. So I do like to sue them. Tax court's a fun place for me to be, not so much for them. I also get involved in audits, particularly if it looks like they're going south. And so again, part of the reason I do that, part of it's fun. I like to fight. Part of it is because it makes me a better lawyer, just as doing tax returns, which I thankfully no longer do, make me a better tax planning lawyer.
Interesting. So, John, what's going on with this new legislation, and why should we be so concerned about it?
It's basically the destruction of self-directed IRAs. Now, they're not honest enough to say, oh, let's ban self-directed IRAs frontally and openly. No, what they did was, there's a story here. The IRS hates self-directed IRAs, partly because they don't do their job. Their job is really twofold. One, to make sure people pay the right amount of tax. But they forget that oftentimes, and they think, no, you're supposed to pay more tax. No, that's not their job. It's to make sure people pay the right amount of tax. Self-directed IRAs are what they would call resource intensive. That's a bureaucratic euphemism for we don't want to do our job. So in 2009, the IRS put in writing, we would like to see self-directed IRAs gone because it's too much work for us.
Yeah.
Senator Wyden of Oregon, and I'm not a real big fan. I don't like Wyden or his politics. He has a major issue with self-directed IRAs. In fact, he's really been the guiding force behind the attack on them for years. He proposed some legislation in 2016 that was about as bad as this. And then Trump won. So obviously Wyden knew at that point he wasn't going to get it through. So it's kind of sat dormant like a half-killed vampire. You have to burn it and pour holy water on it and everything else, or it doesn't die properly. So it's come back. What happened was the IRS talks to Wyden's staff. Wyden's staff talks to the House staff, and they slip it like a dagger between the ribs in 800 pages of dense language, hoping nobody would catch it. Well, we caught it, and we're fighting it vociferously. In fact, we'll talk about how people can fight that here in a little bit. But they're looking to destroy.
So what would it, if it passes, what would it do? What would happen to people?
All right, the three big parts, and there are a lot more moving parts because it's tax, and there always are, but the three big things. One, they're limiting your aggregate retirement accounts, not including defined benefit plans. So they're going to add up your IRA, your 401k, your SEP, your Simples. They're going to add them up. And if you go over 10 million total balance with some adjustment for inflation, they force you to distribute half of the excess. What does that mean? That sounds like something a tax lawyer would say. Let's illustrate. You have 11 million. Okay, the excess is 1 million, 11 minus 10. Half of that is 500,000. You have to distribute 500,000, or they put a penalty of 50%, which would be 250 grand, on what you didn't distribute. So what they're functionally doing is limiting the size of IRAs. Now, we may see that number move up a little bit. There's some pressure. I do think that's going to pass. I don't think politically arguing that people should be allowed to have more than 10 million in their IRA is a popular approach. So I do think they're going to succeed, but it also solves 99.98% of the Peter Thiel problem, right? Think about it, do the math. What happens when we compare 10 million to 5 billion? 10 million is 20% of a percent of 5 billion. That's a 99.98% solution. So everything else they're suggesting is extraneous and about control. So I think that's going to pass. Here's where the two major issues are. First issue, which is half the destruction. If the promoter of an investment requires you to disclose income, assets, experience, or licenses. In other words, if you have to be an accredited investor for your IRA to invest in something, because the way it works is if an investment normally requires accredited investors and your IRA invests, you have to show that you're personally accredited or sophisticated, or for some crowdfunding that you make a certain amount of income. That's gone. And if your IRA does any of that, it dies. Everything gets distributed and taxed. You no longer have an IRA. So it's a very harsh punishment.
That's weird, though. I mean, the securities laws are on one side, naming some investors as accredited based on income and net worth because they can take more risk, right? So that's why that law is in place. But if you invest in something that requires you to be accredited, is that what you're saying? Mm-hmm. Or if you disclose that you're accredited?
If you're investing in something that requires an accredited investor or a sophisticated investor, or for crowdfunding, a certain level of income, because crowdfunding amounts vary based on your income.
Got it. Then what?
You're not allowed to invest in it with your IRA. And if your IRA does invest in it, your IRA immediately dies.
There is no way they're going to get that passed. That would put an entire crowdfunding industry, the whole startup business with all the PPMs, the private placement memorandums, and every syndicator out of business. Like, I can't imagine that they could go against that giant lobby, or am I wrong?
Well, they tried for the quick strike, and now they're bogged down fighting. The progressives and the moderates are not agreeing, and it gave us time. I put up a website, which is handsoffmyira.com. I was the first one to sound the alarm hard. We got like 15,000 hits within 2 weeks on a website that was invented at that just right away. Now, the good news, as you said, it took a while. You'd be shocked. I would call people saying, look, you raise money from IRAs. This is going to hurt you. And they're just like, no. Now they're getting organized and more involved, and given people who raise money from IRAs time to start objecting to this. So I think of all the provisions, this is the most likely to either die or at least be limited, because get this, you have 2 years to exit existing investments.
And we talked about that before, and that would just create absolute chaos. I mean, that would just be a mess beyond comprehension.
It's extraordinarily punitive and nasty, frankly, because I get your contradiction point of, wait a minute, sophisticated investor status was to protect the little guy from strange, risky stuff. And now they're saying, but you make too much money on the strange, risky stuff. So we're going to ban little people from investing in it. And by the way, now we're going to ban you from investing in it because it's too good. So little people can't touch it because it's too risky. And your IRA can't touch it because it's too good. That's what they're saying. It's crazy. Here's the second pincher. So they're hitting you from both sides. The second pincer is your IRA may not own 10% or more of any organization. You can't have a checkbook LLC. You cannot use a personal property trust. You cannot use a land trust. You and I cannot do a joint venture. I'll give you an example. If I say, Jason, listen, I found a project. I'll be the sweat equity. Your IRA brings the money to the table. Let's virtually shake hands. That's a partnership under tax law. That's banned. Why? Because my IRA owns more than 10% of it. Furthermore, my personal ownership reduces the amount the IRA can own. If I own 6% in something, the IRA can only own 4%. So this is going to kill most private joint venture deals, all checkbook LLCs and trusts. And let's think this through. If my IRA has to own less than 10%, it's the kind of deal that we probably need to have a PPM and probably need to have an accredited investor status. There's going to be this tiny area in between. For example, you could still own a rental property in your IRA directly, naked. You couldn't have an LLC for asset protection. You could still do hard money lending naked, no trusts or LLCs for anonymity, for example. So It's really going to limit to a very narrow corridor. They're hitting you from both sides. The little guys are not allowed to own 10% or more or invest in anything where they're effectively an officer or director, where they have power to do, let's call it self-direction.
Yeah.
And then from the other side, it's no accredited investors.
So look, I've been saying for a long time, there is going to be a significant movement to nationalize IRAs. And I think this is a precursor to it. For years I've been speaking this stuff, and you probably are going to agree with it, John, is that a government that is broke becomes predatory on its citizens. Okay, because that's the golden goose, right? And so the low-hanging fruit for them in terms of getting money or nationalizing IRAs is all the traditional IRAs that aren't self-directed, that are just in brokerage accounts. They can just pass a law with a stroke of a pen, and then all those brokerage accounts just become nationalized, right? But a self-directed IRA with a bunch of random fragmented investments is too difficult for them. That's really complicated for them to figure out the value of it, to go and change the ownership of it, and do all of these types of things. So I think what we're seeing is a step in this direction.
It's about control.
Yeah.
It's about control. Look, they're trying to force you off of Main Street into Wall Street. They want control. And this is consistent with decades of, if you have a foreign bank account, now foreigners won't even do business with Americans because the IRS is trying to impose its law on foreigners, et cetera. Yeah. They're absolutely corralling capital and limiting financial freedom and independence. We're building a Berlin Wall out of paper, still backed by guns instead of concrete. They don't care if you leave, your money needs to stay.
Yep. And that's what I said over 10 years ago about California, that they would build an economic Berlin Wall. And of course, the US is doing that. And with Janet Yellen's big push to make a global minimum corporate tax rate of 15%, this is just, folks, the control is just tightening and tightening and tightening. And if they get a digital currency, which they ultimately will, that's got to come. There is going to be a central bank digital currency or a digital dollar or whatever it's going to be called, but it's going to be checkmate. It's going to be checkmate over spending freedom, spending privacy, very disconcerting stuff coming our way.
There are two things we really want people to do. Tell them your story. Look, I invest personally. I bought rentals in the inner city. We did a great job as landlords. We rehab them. So you got to give the story of the social good. But the ones that are doing something would be appealing to a moderate Democrat that they think is a good thing, because that's who we're targeting. Tell the story. Second, talk about how it's helped your retirement. You promised you would go after the billionaires, but you're forcing me to invest with them, the ones on Wall Street. The excuse is get Peter Thiel. Instead, you're nailing me and forcing me into Wall Street. Write them, email them, send them the texts, overwhelm them so that they know. Why? Because the moderate Democrats, like most politicians, want to win. I would appeal to that. You got to tell your story.
Yeah, right. Okay, so what should we talk about? Should we talk about if it happens, or what other strategies, like if it happens, what should we do?
If you're looking to invest in something that may be banned, like a PPM or something, if you're using IRAs, use a traditional IRA. For the moment, they're not targeting 401ks with this. Now, there's other law I haven't discussed that does target 401ks, having to do with Roth conversions, mega Roth, the backdoor IRAs. They're targeting all that as well. It's not a great issue, but it's not as harsh or as bad as this one. I've had a few people email saying, I use qualified retirement plans, I use solo Ks, this doesn't bother me, I don't need to worry about it. Who do you think's next? Now, the interim measure, so I wouldn't get cocky for you 401k guys or you QRP guys who are like, well, this doesn't affect me, so I don't have to write any letters. This is just not a problem. I think that's next. But right now, what's one of the plans? If you invested with a traditional IRA, how do you get the IRA out of a prohibited investment? Roll it to a 401k, roll it to a SEP, roll it to a simple, to whatever. So that's one very basic way to do it. Now, that's a problem with Roth IRAs, because with Roth IRAs, we can't roll those to 401ks. So with a Roth investment, you either have to sell at a fire sale price or you have to distribute, assuming this thing survives. That would be a problem. This is an opportunity, by the way. I'm shocked at how little this technique gets discussed, and it's super powerful from a tax standpoint. Estate planning uses discounting through entities. Let me explain that for everyone. Most people are familiar, but they don't know they're familiar with it. You and I each have a property worth $100,000. We throw it into an LLC. So there are two properties worth $100,000 in the LLC, $200,000 in the LLC. We each own 50%. What's your 50% worth? Now, intuitively, you would say $100,000.
Right.
Tax law, the answer is $50,000 to $90,000. Let's look at the typical PPM structure, because this is where it really works well. In a typical PPM structure, you don't have liquidity and you don't have control. You're stuck in the investment.
And I would say that's the same as a real estate syndication, right?
Yeah. And I use the terms jointly. For me, a PPM is a generic catch-all for that.
Most people think of the PPM as going with a business like a startup. But,
got it. Okay.
Yeah. And any kind of fund you invest in is going to have this if it's not a, publicly traded security.
So under tax law, there's a big discount for owning something you don't control. And if you look at most of these, again, I just use the term generically, the PPMs or syndications, the manager is almost impossible to get rid of. They have to do something horrible on tape twice and be voted out by a supermajority.
Yeah, they're protected like crazy by the business judgment rule and all sorts of other things in the document.
I mean, there are venereal diseases that are easier to get rid of than some of those managers. So you don't have control. And there's a discount under tax law for lack of control because it makes it harder to sell your interest. Your interest is worth less because someone's buying into a lack of control. Second, you have a lack of liquidity, especially if the agreement, let's say it's not publicly traded stuff. Maybe there are stipulations that somebody gets a right of first refusal. Maybe other members have to approve. It is by nature not a liquid investment. And you can put your thumb on that operating agreement and draft it to make it even less attractive. So we just did a deal. It's a small one with private friends. We bought discounted medical paper. We're factoring doctors' bills. And we set up an LLC with 20 people, one manager who had dictatorial control. Any one member could veto new members or sales of any stock. Everyone had a right of first refusal. Based on that draftsmanship, we took this to an appraiser and said, if we invested, let's say 50 grand from our traditional IRA in there, the day before we invest, what's it worth? 50 grand, it's cash. What's it worth the day after we invest? Appraiser came back with less than half, less than 12,500. When would you like to convert to Roth? How much would you, the day after, when that value drops, the day you invest, and that's the lowest value, because as the business matures and you get closer to liquidation, hopefully things are going well, the value is going up, the day you invest is the lowest value date most of the time. That's the date you convert from traditional to Roth. That's a huge opportunity. I put 100 grand in my traditional account. I get 100 grand deduction. I invest that 100 grand in a syndication. I get something that says it's worth 50 grand. I convert it 50 grand. I got to keep half the deduction, but all 100 grand, once it comes out of the investment, or hopefully 150 or some larger number than what I invested, all of that's Roth.
Right. But the reality is a lot of those deals lose money. So you lose real money in the real world now. That's essentially, it sounds like what Peter Thiel did with his Facebook stock, right? But,
different.
That was a out of the park home run, which is unusual.
Well, no, there were some differences. So obviously you always want you don't want to let the tax tail wag the economic dog.
I agree. I don't let the tax tail wag the dog. Yeah.
So we invest in a good deal was my unstated assumption.
Yeah, got it.
And if it's structured correctly, we get the cherry on top of this huge discount on converting. Big deal.
Okay.
Now, what Peter Thiel did was he grossly undervalued. First of all, only his IRA and the others' IRAs had access to these shares. They grossly undervalued what they put him in at. And here's what my argument would have been to take him down. Without going down the total esoterics, you are not allowed to contribute property to an IRA. If you do, you destroy the IRA. You can only contribute cash. If you contribute property, the IRA dies. Now, there's never been any case law because no one's ever pushed it. Here's what I would have argued. Peter Thiel personally had the right to acquire those shares at that price. His IRA never had that right. He transferred that right to the IRA and used it to acquire the shares at an artificially low price. That contribution of property to his IRA was prohibited under Section 408 by IRA. IRS wasn't swift enough to do that.
One of the things I think we should be talking about is the broader economic impact of this. We tend to focus on, well, what if I have a self-directed IRA or a solo K or something and it affects me, right? Well, everybody's concerned about that. But think about the kind of dysfunctional business environment this would create, where all of these syndicators and startups who have collected monies now have all this massive pressure on them from their investors to say, hey, I need this money back in 2 years. You got to unwind this thing. I mean, think of all the bad business decisions that would have to be made and how that would affect the economy.
Oh, yeah. And it's already having an effect. It's already having an effect. Why? Because until we settle, is this going to pass or not? People with IRAs that they wanted to invest in these sorts of things, these syndications, are sitting on the money and waiting and seeing because they don't want to be forced out in 2 years. So it's already drying up capital, which I think this is a great time to, just dry up capital. And just the fundamental unfairness of it. The self-directed IRA and 401k rules are complex. I make a living off of that. But there's also a great big reward if you do it right. And they're switching the ball. Like if you're old enough to remember Lucy and Charlie Brown, you're just yanking the ball again and again. That's not right. But the ability to raise money will be severely curtailed. I don't think the people who wrote this live in the real world or understand just how dependent a lot of businesses are on IRA money.
Oh, yeah. Businesses and deals, syndications, all the apartment syndicators, the office building syndicators, the whatever syndicators, self-storage investments, you name it, right? That is, this would be unbelievable. All of the crowdfunding industry that basically was created out of the Jobs Act that just didn't even exist before, the startup culture, the angel investors. Wow. This is just... The dominoes are staggering from this. I don't know how much money that is, but it would have just huge effects that would just ripple throughout the economy.
So George Gammon, Jason Hartman, and we've created a high-level mastermind group called The Collective. The goal of The Collective is for you to learn from the three of us, as well as, of course, the other members, on how to build and, more importantly, how to maintain your wealth. In this video, we're going to go into detail about what the collective is and what it can do for you. Enjoy. So I'm Ken McElroy. I've been in real estate for over 30 years. Started with a 2-bedroom, 2-bath using my own money, and now I own over $1 billion worth of real estate that I bought over the years, built a big company. We have a construction company, a development company, a property management company, and of course an investment company. And typically now we syndicate and work with large, both private and public institutions for the equity and the debt. And so what I bring to the collective is how to scale, how to grow, starting with one really small property with no experience at all and growing it into an organization, which I've been able to do that basically runs almost without me. So that's what I'm going to bring to the collective. We decided to start the collective because, one, I met George Gammon, and George brings a very interesting perspective about the economy and the Fed and the way money works and Bitcoin and alternative types of investments, which quite honestly, I was super focused on real estate almost the entire time. And even I want to be a little bit more diverse. So when I talk to George and to Jason, they're always doing very, very different things on the investment side. Jason specifically is more focused on the single family housing and what's going on in that market so that we could collaborate and have different viewpoints on different things. And so that's why I thought the collective would be good, because I think everybody's kind of searching for the same kinds of answers. So the collective means to me, basically, the collective group, the whole. And I've always been a big believer of team and collaboration. So for me, it really means collaboration, of everyone kind of coming into a room and learning from each other based on their individual highs and their individual lows, and to be very, very respectful of all their independent views on things, and to be more open-minded, transparent, and authentic. So I cannot wait for the group to get together each and every quarter, because we all have very different walks of life that we're going through. And so it's very, very cool to get into one room with like-minded people. I think the right person for the collective is somebody who's into personal development, somebody who's trying to be a better individual, somebody who's trying to have that work-life balance, trying to figure out good decision-making on the investment side specifically, good decision-making on the personal side perhaps, certainly on their health and on their wealth. The members that have already signed up are people typically that have businesses that they're growing, businesses that they've started or businesses that they've sold. So typically they're higher net worth and they're trying to figure out what to do with their money. They're probably a little bit afraid of inflation. They're probably a little bit concerned about where to invest. And they're obviously looking at real estate as one component, somebody that's trying to do the right things both on the personal side and on the financial side. So some of the experiences that members can expect to get out of the collective are certainly the network. And I think that's always super powerful. I've been involved in groups like this before, like EO and YPO, the Entrepreneurs Organization, and YPO, which is Young Presidents Organization, which is kind of a peer-to-peer network. And that's what I envisioned, and I think people are gonna certainly get that out of there. They're gonna have lifelong friends for sure from this, and they're gonna meet people at every single event. But also, we're gonna have fun. So as an example, things like race car driving and doing all kinds of really cool things and meeting celebrities and things like that and fashion shows are gonna be part of it. So it's kind of how do we have fun and learn together, and we're gonna have that at each and every event. So thanks for watching. If you guys are interested, there's a link below you can click on. It'll take you right to the website, which has a load of information on exactly what the collective is, where the next events are, and what exactly you'll be getting if you become a member. Thanks for watching.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.